The broadcast is now starting. All attendees are in listen-only mode.
Welcome to our webinar on employer tax compliance matters, payroll, benefits and shares. I'm Margaret Savory.
And I'm Charlotte Hobron.
Both of us are tax specialists at James Cooper Creston. It is a busy time of year in terms of employer reporting for employee tax affairs. We have an experienced team of taxation and payroll specialists who assist clients with their various payroll, benefits, e.g. P11D preparation, and share scheme reporting requirements. With this in mind, we thought a timely webinar on the topics listed below with upcoming deadlines would be useful. In the time available, we of course can only give you a broad overview. Our aim is to flag up areas of note that might resonate with your specific circumstances. If you have specific questions, please contact us directly. Our details will go up at the end, or send in a question, as we aim to have some time at the end to have a question and answer session. If there isn't time, we will respond directly to you. So over to you, Charlotte, and P11Ds.
Thank you. So as Margaret said, we are in busy P11D season at the moment, preparing P11Ds for our clients. When the tax year is finished, employers need to submit a P11D form for each individual that they've provided benefits to. This is a form that essentially reports all the benefits that have been provided to an employee throughout the year, and may include items like, for example, medical insurance and company cars. It's important to note, though, that a P11D does not actually need to be submitted for an employee if they're paying tax on their benefits through the payroll, which is known as payrolling of benefits. So the number of P11Ds needed may decrease if an employer has started to payroll benefits recently. Margaret will be talking more about this later in the webinar. The employer will also need to submit a P11D-B form if they've submitted any P11D forms, or if they are payrolling benefits. So this means that an employer will still need to submit a P11D-B form even if they're not actually submitting any P11D forms for the employees. The reason a P11D-B form is still needed is because it tells you how much Class 1A national insurance you need to pay on the benefits. It's important to note that the amount reported on the P11D for each benefit may be calculated differently. It won't necessarily be the amount it's cost you as an employer. It's therefore really important to seek professional advice or read the HMRC benefits manual carefully. There are various different ways of submitting the P11Ds to HMRC, and this can be through the use of commercial payroll software. It can be through online forms with HMRC, or alternatively, downloading the forms and sending them to the P11D support team at HMRC. The P11D forms and the P11D-B form can be amended if there are any errors or any omissions from the forms. The amended P11D form must include all the benefits originally reported plus the amendment or omission. It's not actually just the new item being reported, so that's important to remember. And it must also be submitted on paper, even if the original one was submitted online. Another change, which came in on the 6th of April 2016, is that an exemption is no longer needed to omit business expenses paid to employees. The last thing to remember is that the deadline for submission for these forms is the 6th of July following the tax year. So, for example, for the 2017-2018 tax year, the deadline will be the 6th of July 2018, which obviously is fast approaching. It's also important to remember that there are penalties for late submission. I'm now going to hand over to Margaret, who's going to talk about payroll and benefits in kind.
Payrolling of benefits, or PBIK, is an alternative approach to taxing of benefits instead of using P11Ds, as Charlotte has mentioned. This approach can cut down administration and means that potentially the need for P11Ds disappears altogether, as you can collect the tax on the benefit on a monthly basis via the payroll. Although, as Charlotte has mentioned, there are still some forms to fill out. Certain things are not able to be payrolled, as listed here, so living accommodation benefits or interest-free or beneficial loan benefits still have to be reported on a Form P11D. There are certain practicalities around the payrolling of benefits. Firstly, you as the company must register via the government gateway. We are not able to do so as agents, and you must do this before the start of the tax year. So if you did not do this before 6th of April 2018, you have already missed the boat for the 2018-19 tax year. So you should now be preparing for the 2019-20 tax year, as you will need to have this registered by the 6th of April 2019. I've given the details of the website for how you log on here, so you can click on that when you get the webinar delivered to you. Assuming you have not yet registered for the 2018-19 year, 2018-19 will be P11Ds as normal. And then if there are benefits you wish to payroll, you will payroll them having registered by the 5th of April 2019 for the 2019-2020 year. You as an employer can choose which benefits are payrolled and for which employees this applies. Communication with employees is key, and this must be in the form of a letter telling them what it all means. You also have to give them, by the 1st of June after the end of each tax year, details of the benefits that you have payrolled, what the cash equivalent is, what the relevant amount is for salary sacrifice or optional remuneration, and details of benefits you have not payrolled, so presumably would still be on the P11D. It is also important that you tell new employees this information and remind them in all cases that their tax code may be altered. As Charlotte has already mentioned, P11D forms will still be required for the national insurance on the benefits, still need to be worked out for Class 1A national insurance. So it is important that you keep records each year of this amount. Here's an example that I've taken from the HMRC web pages. If you're given health benefits with a cash equivalent of £600 per annum, previously this would have gone on the P11D, but this year the company will payroll them. You need to tell the employees via a letter that you're going to do this. You as the company need to register online and you will select the medical benefit box. The tax code for the employee will automatically change during the tax year to take out of this benefit. During the year, the employer works out the taxable amount and adds this to the actual monthly pay. The annual cost is divided by the number of pay days in the year, and the employees pay the tax on this amount. So in this case, £600 divided by 12 monthly salary payments is £50 per month. And finally, a couple of points to watch. You can payroll company cars, but to make sure this is not double counted, don't also submit the Form P46. There is additional guidance on the HMRC website with examples for company cars and also interactions with the new tax rules for optional remuneration arrangements. Also, when payrolling benefits, it is important to keep an eye on the tax code and remind your employees to look at the tax code to make sure that the benefit that was included in their tax code, because it was in the P11Ds, has now been deducted, as this benefit will be now going through the payroll. So you want to make sure that you are not double counting by both taxing it through the payroll and also in the tax code. And now I'll hand you back to Charlotte, who's going to talk about optional remuneration arrangements.
So optional remuneration is changes to the salary sacrifice scheme, and these were introduced from the 6th of April 2017. And in some cases, these new rules have limited the tax benefit available to employees. A traditional salary sacrifice arrangement is one where the employee agrees to give up part of their salary in exchange for a benefit in kind provided by their employer. The employee pays the tax and national insurance on the lower salary, and the employer also makes an employer national insurance saving, so a win-win situation. Although tax and national insurance may still be due on the benefit, it's often at a lower rate, and therefore this has generated savings in the past for both employee and employer. However, the new rules mean that benefits provided under this agreement under the new optional remuneration arrangements are taxed at the higher of the benefit in kind received or the salary sacrificed. This may therefore result in a higher tax charge going forward, especially for benefits that were previously tax-free, such as car parking and mobile phones. There are a few exceptions where the previous salary sacrifice treatment does continue, and these are listed on the slide. These are pension contributions, employer-funded pension advice, cycle to work schemes, childcare vouchers, and low emission cars. As I said, the new rules came into effect from the 6th of April 2017, but any salary sacrifice arrangements that were in place before the 6th of April 2017 will only come within the new rules with effect from the 6th of April 2018. There are transitional provisions in place for some benefits, and these are employer-provided accommodation, company cars, and school fees. These benefits will not be taxable until 6th of April 2021, or when any alterations are made or the benefit provided is changed. So, for example, if a different car is provided, then there will be changes, and that will bring it into these rules sooner, unless it's a direct replacement for a car that's damaged. School fees usefully are treated slightly differently, as the transitions will still apply even if there's an increase, provided that the employment is still with the same employer and the amounts are in relation to the same child at the same school. So there can be changes as long as criteria are still met without the new rules coming into play. This is important as employers need to be mindful of the new rules because they need to communicate the changes to employees to ensure that they're aware of any tax changes that may affect them. Employers need to consider how these changes will affect reward packages, as previously tax-effective arrangements may now actually be taxable, and this may mean that employers may wish to review their packages and potentially make amendments to ensure that they're still retaining staff and their packages are still competitive. I'm now going to move on to talk about trivial benefits. This was actually introduced on the 6th of April 2016, so it has actually been in for a while, but not all employers are actually aware of this. Prior to this date, there was no statutory limit on the benefits not taxable, and it was actually up to employers and HMRC tax officers to use a common sense approach based on HMRC guidance. So, for example, general consensus was that a bottle of wine would be trivial and therefore not taxable, but a case of wine would not be considered trivial and that would be taxable. But obviously this did sometimes cause confusion or a grey area. Now we've got the trivial benefits legislation, we actually have legislation stating that a benefit is exempt from tax as employment income if certain conditions are satisfied. You can see the conditions stated on the slide, and they are as follows. So, if the cost of providing the benefit does not exceed £50, the benefit is not cash or a cash voucher, the benefit is not contractual, and is not provided in recognition of any particular services performed by an employee as part of their duties. The reason this benefit has been introduced is basically to cover staff welfare benefits and goodwill gestures, but it has not been brought in to cover recognition of service benefits such as long service awards or, for example, rewards for hitting sales targets. Any regular or frequent benefits or any benefits that are in recognition of service would still be treated as taxable employment income. So, for example, if an employee hits the monthly sales target and is given a £50 voucher, the exemption would not cover this, and this would be taxable because it's in reward of services. But if you give your employee flowers as a birthday gift, this is a goodwill gesture and would be covered by this exemption. So it's quite a useful exemption to be aware of, to be using as goodwill gesture towards your employees. I'm now going to hand back to Margaret so she can talk about national minimum wage.
A key feature of the UK employment legislation is that you must pay workers at least the national minimum wage, or if they're over 25 years of age, this is now known as the national living wage, and this is enforced by HMRC. Just to add to confusion, the national living wage which is what the UK government has in statute, is different from the living wage. The living wage is set independently by the Living Wage Foundation, and this depends on the cost of living in various parts of the UK, ranging from £10 or higher in London to around about £8 in lower cost areas of the country. And the living wage is what's paid on a voluntary basis. So what we're talking about here is the statutory national minimum wage and national living wage. So everything here is statutory requirements. On the next slide, I've just given you the current and historic rates per hour. So there are different rates for different age bandings and whether you are an apprentice or not. And as you can see, it's steadily increased over the years. And when a new rate applies, or someone ratchets up into the next age bracket, you need to do it in the following pay reference period. So basically, the next pay period, you will then pay the higher amount. There are various exemptions to the national minimum wage. For example, if you're self-employed, or if you have volunteers, company directors, armed forces, or family members, and on certain occasions work experience students, but this depends on the length of their placement, all of these are exempt to the national minimum wage. Other workers, such as piece workers, commission workers, part-time workers, must receive the national minimum wage. Although the concept is straightforward, the calculations of the hourly rate is quite complex. The basic starting premise is that the national minimum wage is calculated by reference to the gross pay, and this includes contractual salary, bonuses and commission. It does not, however, include benefits, loan advances and pension payments. In working out the gross pay, there are also certain deductions which are allowed before the national minimum wage calculation, and this includes deduction for expenditure connected with the job, such as contributions towards uniform and tool costs. Tips and gratuities do not count towards the national minimum wage. If you are in a salary sacrifice or optional remuneration scheme, generally the calculation is performed after the sacrifice, although this can get complicated, particularly for things like childcare vouchers and the cycle to work scheme, which have to be made available to all employees. And there is detailed HMRC guidance on this. However, what you must do with any salary sacrifice is make sure that the gross salary is not reduced below the national minimum wage after the sacrifice. Another potential complication for calculation is the accommodation offset. If an employer provides accommodation for the employee, this can affect the calculation, depending on the amount. If the accommodation is provided totally free of charge, then an amount is added to the employee's pay for the purpose of the hourly calculation. However, if the employee has to pay for the accommodation provision is ignored. If the employee has to pay more than the valuation of the accommodation, then the excess is deducted. As you can see, it does get complex. Having arrived at the total gross pay that you want to include in the calculation, this is then taken over a reference pay period, which is basically the time between two pay periods, the longest being 1 month. And the number of hours in that period are identified. And then the calculation is basically to take the total pay, as you just calculated, and divide by the number of hours in the period. This number is then compared with the published rates that I've just given you, and you obviously want to be above the values on the statutory slide, otherwise you will have a problem. In summary, there are lots of complexities around the national minimum wage, and you have to look at each person individually. The BIS, now BAYS guidelines, runs to some 61 pages, and they do have an online calculator for you. There is also useful guidance on the ACAS website, and they also have a helpline number, which I've given to you. What happens when things go wrong and you identify a shortfall? If you as an employer spot a shortfall, the key thing is to make it up as soon as possible. If a worker discovers a shortfall, then a claim can be made to an employment tribunal for unlawful deduction of wages, or they may pursue a breach of contract contract claim in the county court. If a case is brought, the burden of proof to prove minimum wage has been paid rests with you, the employer. HMRC have powers of investigation and they can issue a notice of underpayment requiring an employer to pay any arrears. They can also levy a penalty within 28 days of the notice of 200% of the underpayment, up to a maximum of £20,000 in respect of each worker identified in the notice. They also have other powers, including naming and shaming of employers. In November 2017, HMRC named and shamed some 260 employers who had back pay totaling several millions to about 16,000 workers. You can look it up on the HMRC website. Mainly in the retail and hospitality sectors, but it was across the range, both well-known companies, large, and some smaller entities as well. Finally, there are a number of criminal offences which can also be applied if the national minimum wages rules are not upheld. And now back to Charlotte, who's going to talk about auto-enrolment.
So this is definitely a hot topic for clients at the moment. Even though the legislation's been in for quite a while, we're still finding companies are having to grapple with this. Under the Pensions Act 2008, every employer in the UK must put certain staff into the pension scheme and also contribute to it for them. And this is what is called automatic enrolment, or auto-enrolment as it's come to be known. And it does impose legal duties on employers. This legislation affects all employers, even if they only employ one person. However, not all UK businesses are affected, as auto-enrolment duties don't apply if the company is not considered an employer. So, for example, a sole director company with no staff would not come under this legislation. When the legislation was first introduced, employers fell under the legislation and had to auto-enrol employees at what was called their staging date. Employers could look up their staging date on the Pensions Regulator website using their PAYE code, but the Pensions Regulator would also write to employers both 18 months and 12 months prior to the staging date. Staging dates, though, no longer exist, and from the 1st of October 2017, pension duties now start when the first employee starts work. So employers often don't have any lead-in time. An employer can actually choose to delay auto-enrolment for up to 3 months, and this may be useful for short-term staff that don't wish to enrol, or maybe for employees on a probation period. But they must actually write to their staff to tell them they're postponing. Also, staff whose auto-enrolment has been postponed can actually choose to opt in during the postponement period. So what's the criteria for enrolling an employee? Well, the criteria is that they earn over £10,000 per year, are aged 22 or over, and they're under their state pension date. It also has to be determined whether the employee is ordinarily working in the UK, and we're going to talk about this in more detail in a minute when we look at the next slide. The employees must be automatically enrolled in the pension scheme if they fulfil the criteria, and they will then have to opt out within a month of being enrolled if they don't actually want to be a member. It's really important to note that employers must not be seen in any way to be encouraging their staff to opt out. So if employees do want to opt out, the opt-out notice that they need to complete must be provided by the pension scheme and not the employer. Any involvement by the employer may actually lead to a breach of the law. Once the opt-out's been completed, any contributions made since the enrolment are then refunded. Employees that opt out must be re-enrolled on the 3rd anniversary of the staging or pension duties date unless they're about to retire or they have lifetime protection in place. And the employer must also inform the staff by letter that they have been re-enrolled. There are minimum total contribution levels that must be paid under auto-enrolment, and these may be based on qualifying earnings or a different definition of pensionable pay. The default earnings that contributions are based on can be the earnings between the National Insurance lower earnings limit of £6,032 per year and the upper earnings limit of £46,350. You can, if you want, also base contributions on your own definition of pensionable pay, but you must follow certain criteria. So, for example, depending on what the circumstances of the employee are, it may be 100% of basic pay or 100% of total pay, including bonuses and overtime. From April 2018, an employer must contribute a minimum of 2% with a total minimum of 5%. So the employee, therefore, has to contribute 3%, or alternatively, if the employer wants, they can actually decide to contribute the minimum 5% so the employee doesn't have to contribute at all. The amounts of contributions and setting up the scheme can be quite complex, and the best approach, therefore, may be to engage with an independent financial advisor who can advise you on all aspects. One important point to note is that contributions need to be done on a fair basis. So, for example, the employer shouldn't load the bonus and pay a lower salary and then base their contributions on salary to ensure then that the employer doesn't have to make large contributions. This would be seen as being unfair. There are fines for non-compliance, so it is very important to ensure that you're meeting your legal obligations. Moving on now to auto-enrolment for foreign companies. As I mentioned above, an employee does not need to be auto-enrolled if they're not ordinarily working in the UK. The problem with this is that it's not often very clear-cut, either for foreign employers or UK employers with non-UK employees. And we are finding this is causing a lot of confusion at the moment with some employers. The pensions regulator guidance advises the employer that to assess ordinarily working, they need to assess where the worker begins and ends their work, where their private residence is, what currency they are paid in, and where they pay social security. Generally, if a worker is seconded to the UK on assignment, then they're unlikely to be considered to be ordinarily working in the UK because they're only here on a temporary basis, and auto-enrolment will not be required. However, if you've got a UK national employed by a foreign employer, then they are likely to be considered as ordinarily working in the UK because generally the UK will be their long-term home, and you would then need to auto-enroll them. This second example has caused quite a lot of confusion and difficulties for foreign employers, as often the employer will be contributing to a long-standing foreign pension scheme for the employee and is not even aware of the UK auto-enrolment rules. There is often a solution in this case, though, as overseas pension schemes can sometimes be used as qualifying schemes or for auto-enrolment purposes. EEA and non-EEA pension schemes can be used as qualifying schemes, which means that members can continue to contribute to these schemes under auto-enrolment rather than starting a new UK scheme, if the plan meets certain criteria. However, only EEA schemes can be used for auto-enrolment purposes. So if the employee is not actually already a member of a non-EEA pension scheme, then you cannot then enrol them in a non-EEA pension scheme. This, therefore, may particularly cause difficulties for US individuals who may wish to be auto-enrolled in a US plan. If the foreign employer decides that they actually want to set up a UK pension scheme, then there may be practical problems associated with this regarding payment of contributions because the foreign employer often will not have a UK bank account. The problem with this is that most pension providers will only have the option of paying contributions via a UK bank account. However, we have found recently a couple of providers that don't require a UK bank account, so there are options available if the foreign employer can't or doesn't want to set up a UK bank account, but they are few and far between, unfortunately. The pensions regulator does seem to be aware that this can be complex, as they do state in their guidance that they expect case law to develop over time regarding what the law means by ordinarily working. And it has advised employers to seek legal advice if they're having difficulties determining whether an employee is ordinarily working in the UK. The problem with this is, though, it's not often particularly helpful, as employers are often up against tight deadlines to comply because they weren't even aware of the legislation in the first place and don't have time to seek lengthy legal advice. Hopefully these issues will become clearer over the next year or so as employers test the guidance through practical cases and the pensions regulator becomes more used to these instances and perhaps issues further guidance in this area. Now I'm going to hand back to Margaret for her to talk about share scheme reporting.
I'm now going to talk about a reporting requirement that was spawned from P11Ds in the first instance. It used to be just one box on the P11D, but is now a series of online reports in itself, with the same deadline as P11Ds, i.e. by the 6th of July each year. The reach is wide for the requirements to complete these share scheme reportings, so if you have any employee or directors that in the course of the year have been involved in almost any transaction involving shares or options in typically your company, the employing company, or a head office company, you probably need to complete an online form. So just for the avoidance of doubt, this applies to share transfers, buying, selling, swapping, gifting of shares, or generally just messing around with shares. For example, you may have varied some share rights. And it might also not be shares, but maybe some sort of derivative, such as options or warrants. If you can say yes to any of the above in the past year, you will probably need to fill out one of the online reports I'm going to talk about. The reports are required, just like the P11Ds, for the tax year rather than the accounts period end. So they run from the 6th of April to the 5th of April each year with the July deadlines. There are two different online reports, one of them for enterprise management incentives, EMIs, and one for everything else. EMIs are the most popular form of tax-efficient share option scheme, and there was a wobble last month when the EU state aid status was in doubt. But this has now been renewed in the EU, and we're back on with EMIs. If you haven't done anything with EMIs in the year, you need to complete the other form. And this used to be known as the Form 42, but both are now online forms. You cannot complete them with paper. There is quite an onerous registration procedure through the government gateway, and you need to allow time for this. So it's no good deciding to do these things on the 5th of July, because you need up to 10 working days. You then also need to allow additional time to register the relevant form, potentially further days. And once you're in the registration process, this will roll forward each year. However, a point to note is that if you have no share activity in the year, and previously in a previous year you did, you still have a requirement to fill either a nil return or cancel the registration. So you still have a requirement for nil returns even if nothing's going on in the year if you previously registered. This slide is just intended to ram home the point that there are two forms, one that's for EMIs, you fill in EMI information on that, or everything else goes on the second form. So a few example scenarios there. EMI scheme only, you just fill out the EMI online form. EMI plus unapproved share option schemes, you'd have to fill in two forms. Unapproved scheme only, you just fill in the everything else schedule 40, form 42 form. And then finally, if you have lots of different things going on, the maximum you fill out is two forms. So the EMI information would go on the EMI form, and then all the other information would go on the other separate form. Basically, the key point is that even if you're not doing anything, you probably need to note it on the form. The first thing to be aware about the forms themselves is there is a lot of information required. It's much more than the one tick on the box initially when it was on a P11D. There are now about 40 or so columns of information required, such as who has received the shares or options, their national insurance number, the type of shares, the nominal value, and also the market value. A word about market value. This can often be overlooked at the time of the transaction. Say shares are just being issued for their nominal value to employees. But you will need at that point to be aware of what the potential market value is. And this is really the crux of why HMRC require this information. And back to the form's roots from the benefit system. If value has been received, then potentially there could be a potential tax liability, either for the individual concerned, being the difference between what they've been issued or given the shares for and what their market value is, or through the PAYE system. So as it says on the slide, the share scheme reporting can, at this time of year, focus the employee's attention on potential tax liabilities for the individual, or maybe falling on the employer, and whether it can use a better or tax-efficient alternative. There is also an area of focus when potentially due diligence teams come in, when prospective purchasers are looking at the company and whether it's kept up to date with its compliance. If you are late in filing, there are penalties, just as with P11Ds. So the final message really is that you must take action in advance of 6th of July. So now's a good time just to check if you have any share transactions in the year that you haven't had before, to consider whether you need to register online or get advisors to assist them, because it can take time to gather the necessary information that you need to put on the form. And as I've already said, it takes time to register either through the government gateway and to register for the forms itself. So that concludes our whistle-stop tour, and we will now move on to answering some questions that may have come in the course of the webinar. Do please either type in your questions to us, and if we can't get through to them now, or we perhaps don't know the answer now, we'll certainly get to you offline and respond to any queries.
So we've had one question in on trivial benefits asking, can I give my employees an M&S voucher every month? Would this come under the trivial benefits exemption? Unfortunately, no, it wouldn't. HMRC would see this as a regular reward, which staff would obviously start to expect to receive, and therefore it wouldn't fall under the exemption and would be taxable, unfortunately.
Thanks, Charlotte. I've now had a question that says, what should I do if I realise I should have auto-enrolled? I have one employee and I haven't at the moment. Are there penalties? What should I do?
Okay, I think the first thing is to contact the pensions regulator as soon as you can. Yes, there are penalties, and these can be quite large. I think there's a £400 fixed penalty, but there can also be daily penalties going from £50 a day up to £10,000 a day, I understand. But pensions regulator is also very keen on supporting people through this process. They do understand that companies aren't always aware of these rules. So they are keen on supporting and educating. So I think if you contact them, although there could potentially be penalties, if you tell them straight away, they will then support you through the process and get you up and running.
Do you know, Charlotte, how many people have applied for auto-enrolment? Do we know?
I think there are a lot of companies that aren't aware. I think it might be around the 50% mark that maybe haven't even fulfilled their obligations. So, you know, you won't be the only one, I think, is probably the take-home message. We've had another question in asking what's the deadline for paying Class 1A NIC. So the deadline for this is by the 19th of July following the tax year, or if paid electronically, it would be the 22nd of July. So that obviously is coming up shortly.
And this query concerns share options. It says, we've granted unapproved share options in the year, and they've been exercised. What's the market value? How do we work out the market value? So I guess my answer to that is you should probably get a professional valuation. So typically your advisors are firms of accountants, or there are valuation experts out there. And valuation of shares, it's a science and an art at the same time. So it can depend on lots of factors, such as what the accounts are, what dividends, what other recent transactions, whether your company is listed or not. If, for example, so it is about getting some independent advice, or if you have a recent transaction, taking a view, but I would advise taking some sort of advice for that market valuation. For example, I'm just thinking, if you paid £1 and the market value is now £5, you'll then also need to think about that differential, which is why HMRC would like to know the information about the market value and, say, an exercise price, because there are potential PAYE or tax return considerations as to whether it needs to put through the PAYE or the difference would go on the employee's tax return. And also potentially from a corporation tax perspective, when share options are exercised or options are issued by the company to employees, there may be specific tax deductions that can be available in the corporation tax computation, reducing your corporation tax bill. I think we've probably had enough questions and are beginning to run out of time, and people need to get to their lunch break. So we've just popped up our final slide there, which has our contact details on. So do please email us if you want to follow anything up specifically, and also has details of the next webinar. We at James Cooper Creston are offering monthly webinars, probably with a gap over the summer because everyone will be sunning themselves hopefully somewhere, and not really interested in tax over the summer break. But the idea is we will have regular tax webinars to inform you and raise topical issues for you, and that gives you details of the next webinar. So thanks very much everyone for listening, and enjoy the rest of your lunch break.